Hey guys, so I just wanted to create a quick video to explain how you can trade reversals effectively. Now, when you think about Forex trading in general, the whole market, whenever you're trying to get into a move, unless you're trading a breakout, you're likely going to be trading a reversal. Now, reversals come in different shapes and different forms, and there's different ways in how you can trade reversals. So I'm just going to show you a few ways in which I trade them and a few candlestick patterns as well as chart patterns which I look for. Now, just to get it into perspective, when you're trading a reversal, let's say that the market is in a bit of a sideways range bound move at the moment. So price is just going sideways at the moment. I'll show you on the actual charts in a moment what I mean. But let's say when you can clearly identify a channel like this and you're waiting for price to come either bounce off of here and work its way back up and maybe just continue trading this channel. You've got 1, 2, 3, this is your third opportunity to get involved going down, and then on the way back up there's a few opportunities as well. So why don't people quite often just try to trade in between these ranges just like so? Really simple. Well, in this video you're going to find out how you can do that. Now there's a couple of candlestick patterns which I really prefer to see. I'm just going to draw them out here, make it really simple. So this is going to be to trade a reversal which is going down, so to short the market. But let's just change the color of these just to make it a little bit more simple and clear for people. So that's an upward candle, and then we'll have the downward candle here. So typically speaking, I like to see a shorter upward candle followed by an engulfing downward candle. Even better is to see a rejection, so a wick rejection of the downward candle to be longer than the shorter candle which was trying to go up. And the reason for this is that the wick shows you a bit of a story, because at one stage this candle was looking more like that. It looked as though the market was going to continue upwards. But as time went on throughout that time frame, it ended up going into the red. It worked its way up, it broke the previous high of the last candle, and it worked its way down into a red one. Okay, and there's two parts to this really. One, it shows you the story that price tried to get up and it had a clear wick rejection which was larger than that, and the second one is that it's fully engulfing the previous candle. And in the opposite direction of this, if you're trying to go long in the market, you want to see something a little bit along these lines. Okay, so just turn this green, put a couple of wicks on these, so shorter wick on the down candle, the initial down candle, and then with the up candle you want to see that. And that also demonstrates a bit of a spring in the market. So if anybody's familiar with Wyckoff and his trading or his theories, this can on the smaller time frame demonstrate a bit of a swing which we're going to get in, a spring which we're going to get into in a minute. Now that's all good, but you see these patterns all over the place on the markets, okay? So you can actually see these patterns as prices sort of moving up, and you see them on a regular basis. But the key part to using these candlestick formations is when you're getting to an area of interest, okay? So something like this, for example, is usually described as an area of interest. Let's call it a POI. So a point of interest, let's say. So when price reaches one of these sort of areas where you're expecting price to either struggle or reverse from, that's when you should start paying attention to these sorts of candle formations, because it's not uncommon in a trending market, doesn't matter if it's going up or down, to see these candlestick formations. And if you get involved at the wrong point, it's just going to continue in the same sort of intended direction. For example, the next candle here could just go out and fully engulf this one again. Okay, so it's really quite simple. You don't want to be getting involved in the wrong places, you just want to be doing it at the points of interest. Now if you prefer looking at something like a line chart, I wouldn't recommend looking at a line chart because it's not really how to trade, but generally speaking there's the H and the Y formations which I like looking at. So just to make it really simple, you'll have an upward move. So to trade a reversal going downwards, you have an upward move and then a pullback like what we can see on this, and then you get a break of this previous high, and then you get a break of this low here. Okay, so that's the first sign that the market will be reversing. Then you look at a point of interest on the upward move. So you potentially look at the last upward swing or the last upward candle. Price may come up to it, it won't create that new high, and before it breaks this new high, it actually goes down and it creates a lower low. So essentially what you've got here, I see this on the internet being bandied around as chalk, which is a change of character, but essentially it's just a Wyckoff formation, okay? So what you get is a break of this mini structure here, so you get a break of the new high, and then you get a break with this part breaking the most recent swing low. Okay, so this can be done on the hourly time, it can be done on any time frame. I was going to run through all of them then, but there's no point. But as long as you're doing this and you're looking for this sort of pattern in what we described a minute ago as our point of interest, which is typically going to be along this top area. I know that trend lines are just sort of psychological levels, they don't really mean much, but when you do have an equal high approaching, which is a key area for a swing reversal or just a general reversal, this has a little bit more precedence, okay? Because this pattern will happen throughout the chart, you know, midway through a range. If it happens somewhere like on here, it really doesn't matter so much, okay? There's not enough liquidity in the market to really change the direction. There may not be any supply and demand. You know, you need to look at these key areas. So you get to one of these points of interest, drop down a few time frames, make sure that you get a good risk reward ratio and work it all the way down to the bottom again. So that is essentially looking at a reversal strategy or a reversal pattern going back down. So that's reversing it down. Now, to go back up, it's exactly the opposite, okay? So price is working its way down, you can have like a little bit of a movement here, then you can have a push up, a pull down, push up, pull down, and off it goes. So very, very slightly different from the last one. You have an initial area where price is sort of working its way down, it breaks this little structure low, structure high gets broken, but usually, you know, if that's a wick, that's a good sign. But let's just mark out on here, just like what we have done there, where these breaks are, okay? So there's a break of structure there, or chalk as some people want to call it, and then you get another little break here. Of course you did have them here as well, and you'll quite often that you get a little sort of shuffle, like a little change in direction, very short change in direction, as you're approaching your point of interest. So the point of interest could be down here, for example, and as you're approaching it, some people are selling off their positions just to make sure that they get filled or they get, you know, get their position sorted out. So it will create like a little tiny short-term trend change, and then it goes down, reaches your point of interest, goes back up, breaks this miniature structure high, works its way down, breaks it again, and then the next leg up is essentially where you break the structure and then you come back down, look for your point of interest. So you could be looking for an order block, something which had formed along here to create a bit of a spring, and then off you go. So really, really simple. So now what we're going to do is we're going to look on the charts for examples of where this has happened, and I really don't mind whether or not it's just a candlestick formation like this, or if it's actually a market formation a little bit more like this. It doesn't matter to me, and yes, this is just hindsight at the moment. I am waiting to get into a trade live at the moment, so maybe we'll see that happen, but essentially it's all really, really simple stuff. Okay, so let's just get looking in the charts. Okay, so I didn't have to look very far to try and find one of my first examples. What we have is a downward trending market, or a downward trending move. We've got the immediate low over here. I'll tell you what, let's switch over to bar replay. We had a strong push up. This is on Euro USD. We had a strong push up. I believe that the market's trying to work its way down to an order block down here. But for the time being, what we're doing is a short leg down, okay? So price is moving down, and all what I see the market doing at the moment is there's a move down. The market needs to come back up a little bit, normally to around about a 50% mark, before continuing its leg down, okay? Now, hey guys, I hope you don't mind this quick interruption,
Just a quick note to say that if you're liking the video, please do give it a thumbs up and subscribe, and maybe pay it forward by passing it on to somebody who you know is looking to get involved in trading. Back to the video.
Now, in this area, what I was doing was I was looking for areas of interest where price could potentially react from and reverse from. Okay, so with that in mind, let's just explain a little bit about what's happening on the left. Now, there's serious supply going into the market here. Okay, so this whole section is looking more like a supply area to me. And the reason for that is that there's clearly a lot of positions being sold off, people trying to buy in, people selling off more, lots of wicks being formed. And then we get a little break of this area, again with wicks, and then a last dash up. Okay, last dash up, and then we've got almost one of those candle formations which I was showing a minute ago, where you've got a higher wick and then a breakdown, but it's not fully engulfing. So this candlestick right here, and including that, I would class as my POI, so my point of interest. This is a miniature order block on a clear move down. Okay, so what I was doing is waiting for price to come into here and react. Okay, obviously I didn't trade this. If I did, it would have been showed up on the charts. You always miss some as well. But let's see what happens with the price. Now, bear in mind, I'm looking for either of those two candlestick patterns. Okay, so the first move, what we've got here, is a bit of a drop down, which is good. We also have this miniature change of character forming. Okay, you could take that off the chart if it doesn't stick. And then what do we get? We get almost an engulfing candle. We don't quite get the wick, so I'm still looking for a break of this wick right here. And there we have it. We have a break of that wick, and then what do we have? Within here, we have a miniature order block, which has been created. Okay, right there. So I would essentially be looking to get involved roughly the 50% mark if I can. Try and get short in the market. Put my stops just above that wick, and work it to the first target, which is this low down here. So the first leg is always my first target. Okay. So the first leg of where it got to, and this would be a 8.61% trade. Let's see how it goes. Don't think we do get tagged, do we? No, we don't get tagged. Okay, so this would be a typical sort of setup and formation which I'm trying to get involved in. Price clearly tried to come up, tried to fill this little miniature imbalance just in here. If we drop down a lower time frame, let's drop down to the 5 minute. Let's see how this formed. Okay, very much the same as the 15 minute. It's exactly the same actually. So exact same thing happened. Was there anything clear which happened here? Well, all I could see here is that there's a fair bit of liquidity just being formed above these wicks. So I would call this topside liquidity, expecting a bit of a wick to come up and take it out, which, hindsight is great and all, but, it didn't trigger the trade for me. Let's drop down to the 3 minute. Let's see. This is what I was talking about. When you get to a key area of interest, we were looking at the 15 minute candles or time frame coming down. So you want to try and get a lower entry point if you can, just using the 1 minute candles, or working your way down as far as you can. Now on the 3 minute, the formation is exactly the same. Okay, on the 1 minute, did anything happen? Could we have got anything else? Yeah, we could have done. Okay, so let's move this out of the way a little bit. This is the importance of using multi-time frame analysis as well, especially with trend reversals. But essentially what we had was a very, very small version of what we were demonstrating here, okay? So exactly like what we had there on the 15 minute and the 5 minute and the 3 minute, a break of structure, or miniature break of structure anyway, a chock or whatever you want to call it. We had exactly the same here. Of course, it was just a wick break, which is a good indication that it's not a strong break. It's in this key area of interest which we've got, which is superb. We had an attempt for a move down. We broke it. Also, it was just with a wick, but then we had a clear break here. Now, what you can do is as soon as this happens, if you're watching on the 1 minute, and of course this is near the London Open, so you know there's some sort of reversals to be taken, or you know it's the start of a strong move of the day usually, and seeing these two candles here, or three candles, is showing me that the market is wanting to go down because it's got the momentum behind it. Now, all what I would do is I would look at the push up, so the last push up, which is pretty much this whole area, this candle, and this candle, work its way along. I try to get involved where I can on the 50% mark, so just taking my adjusted Fibonacci retracement tool, and look at that, you would just get tapped in right there. Put your stop loss right there, a 1.3 pip stop loss, and then work your way down, okay? So we knew that our first target was going to be the structural low, or the more recent structural low, which is down here on this line. And what's that? A 26% trade, or a 26R trade. Nice and easy. Now, what you can do again is, because the market hasn't created a new high here, and if you miss this initial one, what you'll quite often get, especially on a reversal structure like this, is a second chance, which is exactly what we get. We get a second and a third chance, okay? So you don't have to worry about missing out on these trades, because they quite often present themselves again and again and again. Now, as you can see, the last push up of these two candles, of course, we don't get a break of this low, but we don't need that because we've already had the structural breakdown here, okay? We haven't had a break of this candle. We've got a clear push down with momentum with this this darker candle here. Price is clearly trying to work its way down. So all what we do again is we mark up on our charts the areas which we're interested in, which is here. I'll try to get involved on the 50%, so on the equilibrium line, which is right there. What kind of stop loss do we get here? A 1.4 stop loss, so even smaller, okay? So even smaller, and our initial target, so not necessarily our only target, but our initial target, where we'd take off, say, 25% or 50%, is down here, okay? So there's a 23.5, that was a 26.5, happy days. So if I was on the higher time frame, like what we were on before, which was the 15-minute, how would that have worked out? Well, we'd have missed those two trades, which is the importance of looking at a point of interest, dropping down to a lower time frame, and paying attention to those really simplistic candlestick patterns. Now, if you guys want to learn this in a little bit more detail, you can always go to, I'll link the, I'll put the link in the description for you, but it's literally just a piece on Wyckoff and his trade theories. Now, it doesn't work 100% of the time, because nothing ever does, but it does have an extremely high rate of accuracy. And the reason for that is it's just explaining the story of the market. It's using the real typical highs, lows, higher highs, break of this miniature structure here, failure to break a new high, and the formation of a lower low. You know, that's all what it's doing. And then an inverse version, let's try and look on the charts for an inverse version. So trying to get a long here, which I did take, I took about 6 trades in 5 minutes the other day. Here we are. Blimey, okay, this is a lot of stuff on the chart. Where are we? 6th of January. I'm going to switch charts just to clear it up. Now, I knew here that price was likely going to be going up. If you look at the higher time frame of the 4 hour, I'll tell you what, we'll do that now. It will just show that the Euro USD has been stuck in a giant range throughout the whole of December pretty much. Okay, so we're just going to go back to the 6th of January now, just to talk you through my thought process and why I took these trades. Let's just simplify it a bit. Now, there we go. I was just drawing out the same sort of formation there as well. And I have a feeling that I did this on a smaller time frame. Okay, so I knew that there was a 4-hour demand block here, which had been purged by this sort of drop here originally. But there was also an order block down here, which was just mitigated, which means that there's usually a little bit of juice left within it. But if we drop down to a lower time frame, we've got a little bit more to go on. So we're going to drop down to the 5 minute. I think it was done on the 5 minute. Yeah, it was. So we had a series of areas which were being broken. Okay, so we had this low being broken by this low. We didn't have this high broken, so the next leg came down and we broke this low. And then we had this high here, and then a new low created. So if we drop down to the 3 minute, what did we have? We had a very clear drop right here. Price came up, didn't create a new low, came up, broke this initial structure right here. So this is where the change of character sort of kicks in. Price came up, smashed right through it, came back down naturally, and then I look for areas where there's going to be liquidity in the market. Now the initial point of interest which I was looking at was here. Okay, the last downward move, it was probably including that wick as well. So I think that I was on the 1 minute, and I believe that there was red news at this point as well, somewhere around, it might have been right here, and I knew that there was a pool of liquidity down here to be taken. Now, if you work your way down on your point of interest, we're on the 1 minute now. I tried to go to the, especially when you've got downward candles and upward candles and downward candles, it shows that the market structure is breaking down. This is showing that people are either selling positions or buying positions. There's a little bit of a fight going on in the market here. And then what we had was enormous pushes straight up. So I wanted to go to the extreme point on this if I could, hence this drawing right here. Now, what did I do? I marked up on my charts, as soon as we got the break of this high, I marked up on my charts as a possible area to be getting involved in. Now this could be done with a pending order, which is what I had here. And then, what did we have? Okay, so price came down, just broke into it, and off we went. Then what did we have? Okay, so we had this other miniature version of, well, the same structure. It's just literally price going like that. Okay, so we got the move down, that's the first leg. Got the move up, which is there. Got another move down, which is here. Got the move up, which breaks this structure here, which is this one. Then price comes back down to a area of interest, which I identified as here, and off we go. So next order went in right here. Tell you what, it didn't, not right there. For some reason I didn't get involved there, but I did on this trade. And then price worked its way up, it came back down again, so it was clearly showing to me that there were orders to try and push the market back up. Okay, we didn't break the structural high, but what we did have was all the correct sort of formations happening in the market. We had rejection wicks on the bottom, we had a clear directional move downwards, we had an order block forming here, so this was the order block when price came back down. Okay, that's making more sense now. Got involved in the market right here. I wanted to cover the wicks below it just in case, but I could easily, yeah, that was an 8.63% trade, but I could easily have just gone with this wick here, but I wanted to cover myself just in case, and of course that would have, you know, doubled my risk reward ratio. Then what happens? Price moves up a little bit, it just about breaks this structural high, just. So a little bit of chock in there as well. Price just broke it, came back down, could get involved in this order block here, didn't. As soon as we got a break of this high here, price came back down, tried to get involved in this, couldn't. Got a break of this high here. Tried to get involved on this last order block here. Literally came down, just tapped an entry. Because I was missing everything out, I dropped this down to the 25% mark. And then off it went. And price just smashed through all my targets, which was superb. And I think my target was initially a 4-hour section. So there's liquidity up here. New price was probably going to have to try and penetrate through that, and then try and work my way to a 4-hour area, which I think was up here somewhere. But nonetheless, that was a few trades placed, 3 trades placed in in about 20 minutes, just because I was looking at a chart at the correct time, because I had the alert set to start watching a chart as soon as this 4-hour demand area was being sort of approached. Now, there's a couple of examples for you. There's a few, on both the buy and the sell, and it's really, really simplistic. So just remember, okay, this is the general market structure that you want to be going by, and there's quite often multiple areas of interest where you can be getting involved in, and it's usually based on order blocks. And if you don't get a formation like that, just literally look for the really, really standard, the go-to engulfing candle. The engulfing candle going that way, or the engulfing candle going that way. Really, really simple trading. Okay, so in a nutshell, that is how to trade reversals in the market. Really, really simple. And don't forget, it's all about your areas of interest. Are they in the correct places? Do they usually signal a reversal? Is it just a range that you're trying to trade? Is it just one of these where price is just going back and forth and you can sort of pinpoint where prices bounce in between? If so, look for these formations and you should do quite well. Cheers.